Something big is happening in the financial world. Real-world assets like treasuries and money market funds are no longer just part of traditional markets. They are moving directly onto trading venues, transforming the way collateral and liquidity flow across crypto. Hey, I'm the AI avatar of Erik. While Erik is focused on the charts, I want to take you inside one of the most important shifts we are seeing right now: the rise of tokenization, also called RWA, and how it's crossing into the heart of trading infrastructure. Let's start with what's new. The BlackRock USD Institutional Digital Liquidity, BUIDL, a tokenized treasury fund issued through Securitize, has grown into a multi-billion-dollar product and is now being accepted as collateral on major venues like crypto.com and Deribit. This means traders no longer need to post idle stablecoins. They can use yield-bearing tokens that represent US Treasuries as margin. In other words, cash on-chain now earns interest while it works for you. That's a fundamental change in market plumbing. And it doesn't stop there. Securitize recently added an off-ramp allowing BUIDL shares to be exchanged directly for Ripple's stablecoin RLUSD, giving traders even more liquidity options. At the same time, Goldman Sachs and BNY Mellon are pushing tokenized money market funds for institutional clients, connecting traditional treasury workflows with programmable blockchain rails. In Asia, the story takes on another dimension. Seazen Group, a large Chinese property developer, has announced plans to tokenize assets ranging from debt to shopping malls under stress. The company has even set up a Digital Assets Institute in Hong Kong to pilot these ideas. Their goal is clear: use tokenization to unlock liquidity in a sector where traditional funding channels have dried up. Whether it's a token tied to Wuyue Plaza or a digital version of private debt, Seazen is betting that blockchain can offer a new way out of China's property crunch. Why does all this matter? Because the definition of cash in crypto is changing. For years, stablecoins like USDT or USDC acted as the main settlement layer, but those coins don't yield anything by themselves. Tokenized treasuries, on the other hand, provide yield and can now also serve as collateral. That means less friction, more capital efficiency, and tighter connections between traditional markets and crypto finance. To understand how BUIDL made this leap from token to collateral, you need to look at the plumbing. The fund is SEC registered and fully backed by treasuries and cash equivalents. Investors go through KYC and are whitelisted. Custody is managed by regulated providers. The tokens are deployed across multiple chains and integrated with venues' risk models. Haircuts, liquidation logic, and margin mechanics have been adjusted so BUIDL can sit alongside Bitcoin, Ethereum, or USDC in a derivatives portfolio. What was once just a concept is now an operational reality. Of course, there are risks. Tokenization doesn't magically create liquidity. Many of these tokens still trade thinly, with restricted wallets and limited secondary markets. Smart contracts and bridges introduce their own vulnerabilities. And in sectors like property or private credit, pricing remains murky and enforcement uncertain. But the trajectory is clear. Each step integrates real-world assets deeper into crypto's market structure. For traders and institutions, the implications are huge. Capital can now move more efficiently. Yield assets can be deployed directly as collateral, and new arbitrage strategies emerge between tokenized treasuries and on-chain markets. Prime brokers, custodians, and trading desks are beginning to adapt, and the line between traditional finance and DeFi is blurring faster than ever. So that's the big picture. BUIDL becoming acceptable collateral, Goldman and BNY pushing tokenized money markets, and Chinese developers like Seazen exploring tokenization to solve liquidity crises. Real-world assets are no longer experiments. They're becoming the backbone of on-chain finance. If you want to know what we are trading or selling and learn how we navigate these changes, join SmartOptions Plus. This content is for educational purposes only. We are not financial advisors.